Is your money safe in a UK bank account? What can we expect if we start seeing financial problems similar to those which we saw in 2007, 2008? So back in 2007, we saw the first run on a UK bank in over 140 years. This was the run on Northern Rock. Here's a news article here from the Time, BBC News. The rush of customers taking money out of Northern Rock continued for a second day on Saturday amid concerns over its emergency Bank of England loan. Now, this was a fairly prudent thing to do if you had a large amount of money in Northern Rock at the time and it looked like Northern Rock was going under. It only survived because it was nationalised and received a lot of money support from the Bank of England. It would make sense. If you had a large amount of money in Northern Rock, you want to get that money out. Most people, when they put money into a bank, they assume at any time in the future they can get that money back out. I mean, it really doesn't work like that. For a start, it's physically impossible. If you take the total sum of all current accounts in the UK and savings accounts, add that up, you get a number that is far in excess of all the paper money that is either in circulation or held at the Bank of England. So for a start, it's physically impossible. If everybody wanted to take their money out of the bank at the same time, there's no way of doing it. There's not enough physical cash in existence to convert that money in the bank to physical cash in your hand. So it cannot be done. It physically cannot be done. And beyond that, the banks wouldn't allow it to happen. The bank you're withdrawing from, the central bank, i.e. the Bank of England, and the government, they wouldn't allow that. If enough people get together and start withdrawing at the same time, they will just stop you. They will not allow you to take your cash out. So no, essentially, it's not particularly safe keeping your money in a bank account during a time of extreme crisis. I mean, for the last several hundred years, we've had more or less periods of fairly financial stable conditions. But if that changes, people will wake up and realise A, it's physically impossible for everybody to withdraw at the same time, and B, the central bank, the government and the banks themselves will not allow it to happen, because by everybody withdrawing at the same time, it will just exacerbate the financial collapse that is happening. So what can we likely expect to happen? Bail-ins. Bail-ins are probably going to be the new bailouts, or at least work alongside bailouts. So previously, 2007, 2008, we had taxpayer money and money printed QE by the Bank of England used to support the banking system. Bailout is somewhat different. A bail-in is people that have money with the bank, or people that are creditors to the bank. They will be the ones that potentially take a haircut on their money, on their assets that the bank has. So expect bail-ins to happen. There's already a precedent for this. This happened in Cyprus back in 2013. So long delay in resolving. Lakai Bank cost creditors over 200 million. So people are still waiting for their money back. When they did the bail-in in Cyprus back in 2013, people are still waiting for their money back. Stricken Lakai Bank depositors are so far looking to receive 5 or 6 cents for every euro they lost when the lender was shuttered in 2013. So for every euro you had in that bank over a certain value, you're only looking to get back 5 or 6 cents on that, which is, most people don't expect that. Most people do not expect when you put, a euro into the bank, you potentially 7 years later may only get 5 or 6 cents back on that. So bail-ins are quite worrying. This is probably something that we'll continue to see in the future. I mean, Cyprus has kind of set the precedent. The UK government are talking about bail-ins. I mean, how could they work? Over a certain value, you could look to the bank turning around and saying, well, look, we don't have the liquidity to give you your money back, but what we could do is, say, give you shares in the bank. Now, that's probably not going to work out that well. They did do this again in Cyprus. So say you've got £100,000 or euros in the bank. They essentially give you what is valued at £100,000 or euros in shares in that company. But who really wants to have shares in a bank that is obviously in serious financial trouble? Because as soon as you get those shares, they're going to be worth a lot less when you go to sell them on. They may even be worth zero. You may get to a point that no one at all wants to buy them. Now, deposits in the UK are insured through the Financial Services Compensation Scheme. One of the reasons why the run on Northern Rock may have happened, maybe why they were on a little bit of a hair trigger back in 2007, because back in 2007 the FSCS deposit insurance scheme was somewhat different. In 2007, only the first £2,000 was insured to the value of 100%. That means if you had £2,000 in the bank folds, in theory, the FSCS would give you your full £2,000 back. From £2,000 to £35,000, you're only insured at the rate of 90%. That means for every £1 you had in the bank, you're only going to get 90 pence back. And then above £35,000, well, that really would remain to be seen. We haven't really seen that level of crisis in the UK, but potentially deposits above £35,000, you may get nothing. It's changed somewhat now. So in 2020, the FSCS insured deposits for per person per bank up to the value of £85,000. One thing I would take away from that is I do not believe in a wide-scale financial collapse. I mean, this is the FSCS own website. In a wide-scale collapse, I do not believe the FSCS, in my opinion, will be able to remain liquid. So just would read some of the key facts about the FSCS. So in 2018-2019, we paid out £473 million to 425,000 customers who filed, customers of failed firms. Who even realised in 2018 there were that many failed firms and that amount of money that the FSCS would have to transfer from failed organisations to the customers who have their deposits insured. 473 million, and 2018-2019 was a fairly financially stable year. Imagine how high that figure would be if you started seeing several high-profile banks. That figure would potentially run into the hundreds of billions, maybe even to the trillions. Now, we've recovered £20 billion from the 2008 bank failures and repaid all 20.5 billion borrowed from the HM Treasury that year. So in 2008, the FSCS had to borrow £20 billion from the Treasury. So there's no way the FSCS, in my opinion, there's no way the FSCS is going to remain solvent. There's no way they're going to be able to insure deposits up to the value of £85,000. If they needed HM Treasury support in 2008 to the value of 25 billion, I think something like the FSCS gets something like 500 million pounds a year into its coffers, which it can then distribute as it sees fit, obviously to people that have been involved in financial firms that have collapsed. But there's no way the FSCS, in my opinion, is going to remain liquid during a large-scale collapse. If you saw one of the big banks or a few of the big banks becoming insolvent at the same time, in my opinion, prepare for a haircut. You're probably not going to get all of your money back. You may even get something like the Cypriots getting 5 or 6 cents back on the euro. Now, is this a realistic thing to happen? My humble opinion, I think the financial situation is many-fold worse than it was in 2008. They managed to rescue it. They managed to defer a lot of the problems. Most of the debts that are in the system are either still there or they are many-fold bigger than they were in 2008. This problem isn't going away. I'm not saying there's going to be a banking collapse tomorrow, but it could happen. And bear in mind, if it happens, your money may be locked into the bank. Prepare, the FSCS could potentially go bankrupt or be insolvent itself, which you may think, well, I haven't got £85,000 in the bank, but that may be rapidly revised down. Expect the possibility of being remunerated with shares in the bank rather than getting your money back. I mean, the lower the amount of money you have in the bank, the more realistic chance you have of getting all or at least some of your money back. I mean, high net worth individuals, I'm not sure how many of them are left now that keep their money in the bank. Essentially, interest rates are near zero anyway. So it doesn't really make sense to keep large amounts of cash in the bank because you're not really getting any interest on it anyway. One thing I would argue is it's probably quite prudent this time to hold some cash at home. If you've got a fairly safe place you can store it, a fairly safe place you can hide it. Obviously, the risk of burglary is probably going to be the number one thing you need to think about. But bearing in mind that you're basically getting zero interest in the bank anyway. And factor in that the inherent nature of the banking system is highly unstable. It makes sense to keep some money at home because you're getting no interest in the bank anyway. Potentially in a wide-scale collapse, physical cash may have a premium over money in the bank, because if you go to a shop or you need to buy something and that person is just essentially getting electronic money via your debit card or credit card, to them that money is still trapped in the banking system. Physical cash is possible, may trade at a premium. Something like we're seeing with gold at the moment. If those of you that follow the gold markets, physical gold is trading for a much higher premium over, say, ETFs and spot price of gold and even futures markets, because the market is now pricing in counterparty risk. A physical gold coin in your hand has more value than a derivative on the financial markets, which who knows who's on the opposite side of that. It may get to that situation with physical cash where a physical £20 note in your hand may actually have higher value than a £20 that you're just going to pay via a debit card. So it's certainly going to be interesting times. It's certainly one to think about. If you've got a large amount of money, I'm not saying take it out the bank, but just think carefully. In a financial collapse, remaining solvent is the key. When everybody else is going to the wall and potentially not being able to pay their mortgage or their rent or buy food, those that remain solvent will have great opportunities thrown at them, because there will be distressed assets you could potentially purchase. There will be businesses that you may be able to snap up at, fire sale levels because everybody else is going to the wall. Do you really want to be in a situation like that when you think, hey, I could buy this amazing car, a car I've always wanted, that's now 25% of its previous value, nice classic car? If your money's in the bank and the bank turns around to you and says, oh well, yeah, Mr. Jones, you've got £50,000 in the bank, but unfortunately because of the current bail-in procedures, you're not going to get that money, or it's going to take you 7 years to get that money back. It's going to be quite a frustrating time anyway. So certainly one to think about. I'm not saying draw your money out of the bank and keep it in a shoebox under your bed, but think of the different options. Just understand the system. Understand that there's not enough physical cash in the system to pay everybody at the same time. So A, that's firstly physically impossible. The bank, the central bank, the government won't allow that to happen anyway. And the system is unstable. That is the current nature of banking in 2020. It's an unstable mess. That's why I always say gold is money. Everything else is just credit. Thanks for watching this video, guys. If you like it, like, comment, share, subscribe. Let me know your thoughts and opinions on the state of the UK financial industry, and that of which across the entire globe, pretty much all this is applicable in the US, Canada, Australia, Switzerland, etc. Thanks for watching the video, guys, and I'll see you in a future video.